So we'll continue with accounting of a sole trader. We've talked about how we close the closing stock, we talked about it. We talked about, what else did we talk about? We talked about the closing stock. What else did we talk about in the previous class? We talked about advertisement, which is an expenses. So today we're going into provision for bad debts. What brings about, stop right here please.
We talk about stationery.
Stationery. Yeah, we talked about depreciation, yes. So today we're going into provision for bad debt. We're talking about bad debt. What really brings about bad debt? In as much as a business sells on credit, it is expected that some of the debtors will not be able to pay back, will not be able to pay back. You are selling on credit. If you are selling on credit, you should be expecting that not all your debtors will pay back. It doesn't make sense here. You sold on credit. Do you know what credit is? Do you know what credit is? It means you sold to a certain individual. The individual does not pay now, it's going to pay later. That is credit. So if there is a business that sells on credit, the business that sells on credit is called the creditor. The business that buys on credit from the creditor is the debtor. Do you get the 2 points here now? There is a business that sells on credit. The business that sells on credit is called creditor or trade payable. Trade payable. That is the business that sells to you on credit.
So, Mr. As I understand, the creditor will give his money to the debtor and he...
Not money, goods.
Goods, yeah, goods. And he does interest in the goods.
No.
Like 2%, like a bank.
No, that is interest, it's not. We're talking about when goods are sold on credit. When you talk about interest, it's becoming a loan. Here, you are buying a product, and the product, you are buying a product, and the product is sold without payment. That is what credit is about. I bought these markers from you as my supplier.
Yes.
I did not pay you, but I have bought the markers. I'm going to pay you tomorrow, after tomorrow, next week, next month.
Or maybe when you finish all your markers and send them.
Then I will pay. That makes you my creditor and me the debtor. Do you get the difference here? So before you came in, we were talking about provision for bad debt. There's provision for bad debt because certain business sold to certain customer on credit. And when we talk about credit simply means I'm buying from you right now, but I am not going to pay you now. I'm going to pay you at a later date. That is credit. Do we get credit here? So if you have sold to me on credit, you are the creditor. I, that I purchased from you on credit, I am the debtor. Do you understand the creditor and debtor here? The business that sells on credit, creditor. The customer that buys or the business that buys on credit, debtor. Any question about creditor and debtor? Good. Now, the business are sold on credit. Because the business sold on credit, the business would have sold on credit to a lot of customers, possibly, yes or no? The business would, I'm a business, I've sold to you have sold on credit. You are all my debtors. But one of you might not pay back. So because I know that one of you might not pay back, I made a provision for that. That is what provision for bad debt is. A bad debt is a debt that is unrecoverable, uncollectible. It has to be written off. You have to pay it yourself. It becomes an expense for you. So in as much as one customer does not pay back, then the business is having a bad debt. Do we get a bad debt here? Do we understand bad debt or not? Yes. So there's bad debt. Provision for bad debt means I am preparing ahead of time. I am preparing ahead of time in case one of you do not pay back, doesn't pay back. That is what provision for bad debt is. Do we get why we have provision for bad debts now? A business is having a provision for bad debts. A business is having a provision for bad debt because one of the credit customers might not pay back. So you are preparing certain amount of money in case the debt goes bad. That is provision for bad debt. Do we understand provision for bad debt now, please? Do we understand? Any question up to now? So look at provision for bad debt. I said the bad debt is an outstanding amount owed to the creditor. Who is the creditor?
Someone who
Take money for that.
the one who gives product to the debtor.
The one who gives money.
The product on credit to the customer is a creditor that is considered uncollectible and must be written off as a loss. So the money, the product has been sold, money is not received, then it should be considered as a loss. That is provision for bad debt. So a bad debt is an outstanding payment that is not collectible. You won't get the money. You have to pay it yourself. It becomes an expenses for you as a business. Any question up to now?
No.
Is it clear?
Yes.
If it's not clear, please tell me. Okay. So what are the causes of bad debts? Why do we have bad debts? Number one, customer bankruptcy or insolvency. What does customer bankruptcy mean? The business, yes? Yes, thank you. The business doesn't have money anymore. The business cannot continue with money. So if the business cannot pay, the business will declare itself as bankrupt. So it goes to administration. So if the business has declared itself as bankrupt, there's nothing you could do. Your money is gone. The business could not pay back.
Why?
It's bankrupt. It doesn't have money anymore.
But Mr. I gave him the product.
Yes.
You should pay it back. So if he doesn't pay it, I will take one of his assets.
The business doesn't even have.
Right.
The business is insolvent.
Oh.
Yeah, the business is insolvent. Listen, this is how it works. When the business is said it is bankrupt, it is a declaration. It's not that I just woke up today and say I'm bankrupt. No. The government would have approved it that this business is unable to pay back. Do you get the point I'm making or not?
But Mr. There is another thing that can do it. They tell him to take a debt from the bank and give him more money.
The business does not have the capacity to get cash. The business is in a stage of administration. It needs help.
So how can I get my money back?
That will be done with government or a firm. What I'm saying is this: as soon as you declare yourself bankrupt, it simply means you need a help. Government will pay part of it, or a business or investors that are willing to take up your business. They're going to pay you back. Trust me, it might take time. But before then, you have to close your account. In the course of closing your account, that is why you made the provision for the debt.
So it's a loss of sales.
You could get it. There's what we call recoverable. Irrecoverable debt recovered. The business might be able to pay at a later date, but presently it cannot pay.
So you need to wait.
You need to wait, but you need to close your account. Because the account of this year must end this year. Do you get it? That is why we made provision for bad debt. Any question about that? So the first cause is this: customer bankrupt. If a customer is bankrupt, it simply means the business does not have the financial capability to pay back debt. That's the first reason. The second one, disputed invoice. Sometimes you and I will not agree on the amount of money I'm owing you. Oh, the invoice is saying 5,000 and I think I'm owing you 4,500. So we have dispute, we have disagreement. Until we can solve that issue, the payment will not be made. It is better you stop writing and listen more now. When I'm talking, you stop writing, please. Stop writing, please. The second reason why we could have bankruptcy is that the business and the customer are having issues regarding the invoice. What is an invoice? An invoice is a document stating that you have received certain products which you have not paid for. There's a receipt, there's an invoice. A receipt is an evidence of payment. If you are issued a receipt, it means you have paid for the product. But if you are issued an invoice, it simply means that you have received the product, but you are not yet paid for the product. So if you and and I do not agree on invoice, then the payment would be delayed. But the business has to close its account. Pending the time, we are able to solve the issue. That's the second reason. Do we get it? Do we get the second reason here? The third one, ineffective collection. This is your own problem as a business. You don't know how to collect your debts. You are careless. You don't put into consideration. You are not structured. You are not functioning well on how to get back your payments. You don't have a plan for it. If you had a plan for it, you should be able to get your money as at when due. So these are the three reasons why we could have a bad debt. Any question about the reasons? Are they clear, please? Are they clear? Good. Now we have adjustment. What is about adjustment? Adjustment simply means, so for adjustment simply means things change over time. Business we do will change over time. It's not going to be constant because we are human. Transaction will come in and go out. So as soon as transaction comes in, it has to reflect in our account. So whatever situation we find ourselves, it must reflect in our accounting. That is why we have adjustments. If a customer is paying, it has to reflect. If a customer is getting a product from you without paying, it has to reflect. That is what adjustment is about. Do we get adjustment here? Adjustment means you are putting things in order. You are putting things in shape. You are doing things the right way. That is adjustment. So, when there is adjustment for bad debt, an increase in bad debt means you are paying more because the cash you are supposed to get was not recovered. So it becomes an expenses for you. So if your bad debt increases, it means your expenses has increased. And your expenses has increased in relative to the profit you make. So as soon as your expenses increases, your profit does what? Drop. Does it make sense or not? There is adjustment on provision for bad debt. If your bad debt increases, it means your expenses are increasing. And if your expenses is increasing, it simply means your profit is dropping. So there's inverse relationship between profit and expenses. If expenses is increasing, profit is dropping. If expenses is dropping, profit is increasing. Inverse relationship. Do we get that? Do we get it, please? Great. And a decrease in bad debt increases income. On the other hand, or in contrast, if your bad debt is reducing, your income is increasing. So it is good for the business. Do we understand adjustment here, please? An increase in your bad debt increases your expenses, reduces your profits. A reduction in your bad debt reduces your expenses or increases your income and increases your profit. But both of them have to be taken away from whatever profit you make. Your bad debt increases or reduces, you have to take both of them away from your profits. Do we get it? Any question up to now? Any question? Okay, so we have a question. Delta was this, provision for bad debt is this. So this business in question has the total number of 90,000 outside of the business. So business has 90,000 from debtors. The business is expecting 90,000 from its credit customers, but it makes a provision for bad debt of 3,000. The debtors are owing it 90,000, but it makes a provision for 3,000 in case the debt goes bad. So it's keeping 3,000 aside in case the debt goes bad. That is what this analysis is about. So how do we now adjust? You have a question? Okay. Do we get it up to now? This is a question. So we want to make adjustments. The debtor, who are your debtors? Debtors are the credit customers. Credit customers. We call them debtors. Do you understand debtors here? Those customers that buy from you on credit, they did not pay. They bought and you issued an invoice for them. So you are expecting them to pay at a certain time of the year. Clear? So that is about this. Now, the additional information we have, we said provision for bad debt is to be adjusted by 5%. So we are adding now. We are making adjustment now. So the additional information is that the business is making provision for bad debt for 5%. Already, the business had a provision for bad debt of 3,000. Now, the business is adding 5% to it. Do you get the information there? Provision for bad debt is to be adjusted by 5%. That means the business is adding up 5% on provision for bad debt. So how do we do that? Where do we get the 5%? It means we need a new provision, because this is what? The old provision. Are we getting it, please? The old provision was 3,000. Now there's an additional information stating that the business is adjusting provision for bad debt at 5%. Do we get something here? So with this 5% on the debtor, it will be your money. So the new provision is the amount of debtor, because we are making provision based on those that are owing us, yes or no? We're not just making a provision because we have to make a provision. We are making a provision for bad debt because some customers are owing the business. And these customers have to pay back. In case they don't pay back, we have to make adjustments. So now, before now, we have 3,000 as our provision for bad debt. But there's additional information stating that 5% should be increased on provision for bad debt. One of the reasons this might occur is because the debtor has increased over time. Maybe before now, the debtor was 60,000. But now, the debtor has increased to 90,000. So you need to adjust it. So, 5% of this, 5 times 900, that's 4,500. That's 4,500. Do we get it, please? Any question about that? Any question about, yes?
Is the money from the debtor
Yes.
back, or
Money from the debtor that might not be paid back. They are our debtors. They are all our debtors. But some of them might not pay back. So we need to make provision for that in case the debt goes bad. So it's 90,000. Now we're making adjustments. They said, now that it has increased to 90,000, 3,000 might not be enough. Let's add 5% to it. So 5% of the debtor is our new provision made. So the new provision is what? 4,500. So new provision minus old provision is now our expenses.
1,500.
Do we get it or not, please?
Yes.
So that means we less this, we have 1,500. Any question about that? Any question about it, please? So now, the adjustment has been done to be 1,500. Do we get it up to now? So please write this before we go further. Okay. So, from here, so the business has made an adjustment. So 1,500 becomes the expenses. So in your profit and loss account, you're going to have provision for bad debt as 1,500, which will be taken away from your profit. Any question about that? Is it clear? Now, we go to our balance sheet. The balance sheet is an account that states the financial position of the business. So in the balance sheet, we have assets, we have liabilities, and we have equity. So here, provision for bad debt is made. So we go back to our assets. This is our current assets. Current assets in the balance sheet as debtors, because this account we are expecting it to pay us back. So it's an asset to us. If we are to pay back to someone, that is liability. Asset means you are expecting certain cash from your credit customers. That's an asset. But if you are owing certain people, you have to pay back. That is liability. So debtors is 90,000 stated here. Yes or no? But now the old provision made is how much? 4,500. So which simply means that the only amount that can be made for provision in our balance sheet is 4,500. Here, your expenses were supposed to be 3,000. Now your expenses has increased to what? To 4,500, which is 1,500 additional. Please get the point here, please. before now you are paying, you made provision for 3,000. Yes or no?
Yes.
Doing this, you have 4,500. So your expense, your bad debt written off has increased by what? 1,500. And that is what? An expense. Remember here I said, an increase in bad debt reduces the profit because it's an expenses. So here, the provision before now was 3,000. But 5% of 90,000 gives us 4,500. You less it from the old or the previous provision for bad debt, which was 3,000. So your expenses account will have additional 1,500. So this goes to your expenses now.
So 4,500 minus 3,000.
Yeah, it's 1,500. So your bad debt has increased by 1,500. Do you get it now? If this was maybe 2,000, it means your provision for bad debt has reduced. It will become income. Does it make sense now or not? There are two situations about provision for bad debt. The first one is that it could increase. If it increases, it becomes an expenses, like this situation. Okay. Do you have any question up to now? So here, it has increased by 1,500. So your expenses account, your profit or loss account will have 1,500 as provision for bad debts. That is done. Then the whole amount, which is 4,500, has to be taken away from your debtors. Because how do you get provision for bad debt? You get provision for bad debt because you have debtors who have not paid back. So you're making adjustment. You are making a provision in case they do not pay back. But the whole amount that you could make provision for is 4,500. So it is expected that 0, 0, 5, this becomes 9, right? 5, 85,500 is your new debtors.
This can you right there?
Yeah, sure. Which one? The old class.
The provision for bad debt.
I'm just going to record it. A business makes provision for bad debt because certain customers, part of whoever you sell to on credit, might not pay back. In case they don't pay back, you have to make a provision for it.
What's a provision?
Provision means you are making arrangements. You are making an arrangement. I sold to you, I sold to her, but you might not pay back. So in case you don't pay back, I need to pay back. In case you don't pay back, I need to make an arrangement for that. Do you get what provision is here now? Do you get it or not? The point is this: in as much as you are selling to someone, you should be expecting a two situation or scenario. Either the person pays back or doesn't pay back. If he doesn't pay back, you have made a provision for it. Because you have to close your account for that year. You don't wait.
How do I make
Certain money from your account, you put it out. And if the person pays back, you take your money back, it becomes an income.
Mr. The additional information, that's for depreciation.
No, there are different additional information, it depends. This is additional information for provision for bad debts. Provision for bad debt is to be adjusted by 5%. It is adjusted because maybe the debtor has increased over time. So the new provision for bad debt will be 5% of this minus the old provision. The old provision, that takes you to the profit and loss account. But the old amount will be taken away from your debtor in the balance sheet. So whenever we have accounts like this, either we have to work on the profit and loss account and the balance sheet. What do you do with your profit and loss account? You put expenses or income in your profit and loss account. Then owings, like liabilities or assets, has to go to the balance sheet. And that is how adjustment is done. Is it clear? The next one is going to be on interest. I'm going to explain that further.